Good afternoon, everyone, and welcome to the Scotsman's Annual Investment Conference 2021, the first time this event has been held online. My name is David Lee, and I'm your host today. Just over a year ago at the Sheraton Hotel in Edinburgh, this was the last in-person event that I hosted before the world changed. Some of you might remember how we all awkwardly bumped elbows and wondered aloud what would happen next. It would probably be very interesting to replay some of those conversations today. None of us could possibly have imagined the almost unimaginable way the last 12 months have unfolded in all aspects of our lives. As far as the markets are concerned, how many of you listening in today were in sheer panic mode a year ago as the markets plunged? And how many of you were subsequently surprised by the rapid bounce back? Today, we take stock and assess where we are now, where we might be going next in the short and longer term, and we'll hear some expert tips on how to invest wisely. Thank you very much indeed to Martin Currie and to Rathbones for supporting this event, and to all of you for joining us today. Martin Currie is giving away a bottle of champagne and Rathbones a hamper to 2 lucky attendees drawn at random, and I will announce the winners at the end. Before we start, I'd like to pay a short tribute to a giant of Scottish journalism who chaired this event on many occasions and chaired many other business and political events with great aplomb. Bill Jemison, who passed away in November last year, was a truly great man, an exceptional journalist who combined deep knowledge and enormous skill with both the written and spoken word, with being a genuinely lovely human being. I was lucky enough to work with Bill at the Scotsman for almost a decade, and he was one of those elder statesmen who was always very generous with his time and always ready to praise a young colleague for a job well done. He also had that rare ability to explain complex ideas, especially around business and the economy, in an easily understandable way. At this point, Bill would probably be cursing under his breath and telling me to get on with it, so I will, and introduce today's event. We will hear first from 3 speakers, and then we'll move into a Q&A session. Please post your comments and questions via the chat box or on social media using the hashtag Scotsman Investment 21. I will try to get through as many questions and comments as possible in the time available to us. I know that everyone's time is precious, so we'll finish on time at 3:45 p.m. sharp. Later on, we'll hear from Iona Bain, a writer, blogger, broadcaster, podcaster, and commentator who founded Young Money, and a signed copy of her new book, Own It, will also be given away to one of you later. And we'll also hear from David Coombs, who is head of multi-asset investments at Rathbones. But first of all, can I welcome Zehrid Osmani? He is portfolio manager for Martin Currie Global Portfolio Trust, and he is going to speak on harnessing megatrends for sustainable growth. Zehrid, over to you.
Thank you, David, and good afternoon, everyone. Thank you very much for joining us, and thank you to the Scotsman for having us in this conference. My name is Zehrid Osmani. I have 23 years experience in financial markets. Some of you know me from my time as senior portfolio manager and head of research at BlackRock, or from my time at Scottish Widows as a portfolio manager and head of research on European equities. I have spent quite a lot of time in Scotland, so caught a bit of an accent, but otherwise I am French, but I have lived in the UK for quite a long time now. I took over the leadership of global long-term and constrained equities at Martin Currie in May 2018, and took the leadership of the Global Portfolio Trust in a joint portfolio management role with Tom Walker, my predecessor, in June of 18, and as sole portfolio manager in September 2018 as part of a carefully managed succession planning. So we hope Tom Walker is enjoying his retirement. I certainly handed over a trust that was in very good shape, and we're grateful to his efforts. Global Portfolio Trust, an introduction very quickly. There are 6 aspects that we want to highlight. Firstly, we are high conviction and high quality growth in terms of our focus. And by high conviction, we're talking about 25 to 40 companies. Currently, we're invested in 31 companies. We're fundamental in terms of how we find those quality growth companies, and portfolio construction for us is key. Even in a high conviction concentrated portfolio such as the one we manage, it is important to focus on portfolio construction to ensure no unintended risk exposures. ESG is also at the heart of our process. Those of you who know us at Martin Currie know our credentials. We are AAA+ rated by the PRI for the 4th year in a row, which we're very pleased with. And ESG is embedded in our fundamental analysis. We are also truly global as a trust, which permits us to capture the best opportunities for our shareholders and investors across the globe. And finally, through Global Portfolio Trust, you have access to the benefits of an investment trust structure, notably low charges, quarterly dividends, no performance fee, and a zero discount or premium policy to ensure liquidity. We wanted to highlight our 5 competitive advantages. The first one, and at the heart of what we do, is we are high conviction investors and long-term in our time horizon. We're fundamental and systematic in how we research the stock ideas on behalf of our shareholders. We have accounting expertise to ensure that we only capture companies where we're comfortable with the accounting practices. This is a way for us to protect our clients' assets. We have a vast array of proprietary fundamental data, which gives us a better understanding of how we position our clients' assets and enhances our risk analytics and ultimately portfolio construction. And finally, we've got the stewardship leadership, which we have taken to a higher level of leadership with some proprietary ESG risk assessments, which we will show you later on. Here we're showing you our systematic fundamental assessments of risks on every company that we research. We assess each company across 4 areas of risks, which are industry risks, company risks, governance and sustainability risks, and portfolio risks. And the importance of this framework is to ensure that we're very detailed, consistent, structured in our analysis, so that at the end of our research process, we have a good understanding of all the fundamental risks that we're putting our clients' assets in. Whether it's industry risks, because we want to make sure that we capture companies that operate in industries where dynamics are supportive for value creation. Whether it's a company risks that we're highlighting here, of which accounting risks that I mentioned earlier. Or governance and sustainability, because for us, governance is indeed important for value creation, but sustainability is just as important, if not more important, to the long-term viability of any business model. And finally, portfolio risks, to ensure that as we look at a company, we're already thinking about impact it will have on the portfolio risk exposures. Warren Buffett once said, risk comes from not knowing what you are doing. And by having this structured, detailed, consistent framework, that is the risk that we aim to eliminate. On the ESG side, we have 6 important differentiators we wanted to put forward. The first is that we're the highest rated trust in our universe in the AIC global sector in terms of ESG as rated by the Morningstar Sustainability Rating, where we gain 5 globes. Secondly, we're in the top 2 percentile worldwide in terms of trusts in the Morningstar Global Equity Large Cap category. Thirdly, we have over 50 ESG risk assessments that are proprietary, that we're assessing every company on to ensure we have a full understanding of the ESG risk exposures. Furthermore, on the social factors side, we are rated best in the sector for social factors. But this is an area that we do not relax and do not rest on our laurels. We have introduced some additional social exploitation risk assessments that we will show you later. Additionally, I mentioned earlier, we are AAA+ rated by the PRI for the 4th year in a row, which sanctions our ESG expertise. And we are top 9th percentile in terms of active ownership in the companies that we're invested in. And finally, we have a low carbon footprint, which is something that has been awarded to the trust as a designation according to the MSCI analysis. Very quickly here, we're highlighting our 52 parameters that we're assessing each company on: governance, which is a column on the left, and sustainability, which is a column on the right. And the aim for us is to go into a lot of detail across the various areas. On governance, we're assessing boards, management, remuneration structure, and the culture of a corporate. Within management, you can see we're looking at management quality, breadth, depth, competence. Also, their ability to manage through crisis. This is something that helped us greatly in the last year as the pandemic crisis hit the world. On the sustainability side, we're assessing environmental and social risks, but also understanding and integration of those risks into company targets and ambitions. And we're assessing every company in terms of 5 common factors, which are climate change, cybersecurity, human capital, customer trust, and taxation. And you can see the importance of this for us, because our belief is that in order to have a sustainable business model, you have to focus both on governance and sustainability. And you cannot have a viable business model in the long term if you do not focus on sustainability as an important focus. On this slide, we're highlighting the exploitation risk assessment that we're carrying on the social risk side. On the right-hand side, it's a repeat of the previous column that you saw. And the exploitation risk behind it are over 20 parameters that we're zooming in on the left-hand side. Social exploitation is very important and has become even more important for various reasons, of which the various corporate issues that have come to light last year in the UK. So we're assessing every company in terms of their production, geographic footprint, which gives us an ability to assess where there are areas of risks in countries where they might be operating. We then assess each company in terms of the detailed supply chain analysis, whether a supply chain is fragmented, whether they have good knowledge of their suppliers, good reporting and monitoring processes that they've put in place, and whether companies are actively involved in improving their suppliers' standards. And then we're assessing every company in terms of risks of wage, age, gender exploitation, but also racial, ethnic, or religious exploitations, as well as various other aspects such as working conditions, degree of skilled labor that is being used, degree of unionized labor within the supply chain. So you can see how detailed we are, how structured we are, and the aim of this framework is to zoom in on areas of risks, the so-called orange and red flags within our framework, which is where we're then doing more detailed analysis, engaging with companies, and aiming to drive positive change. We're also assessing the portfolio in terms of long-term structural opportunities, which is something that we highlighted last year. This is our thematics analytical framework. We've identified 3 mega trends, which we've color-coded in blue: demographic change, in green: future of technology, and in black: resource scarcity. Within those mega trends, there are themes which we've listed on the left and on the right, which are also color-coded. And through this analytical framework, we're able to assess every company in the portfolio and assess how exposed it is to the various themes. This permits us to then aggregate the data, which is what this shows you at the portfolio level, and assess more accurately which themes are running through the trust and to what extent. We're then able to make sure that we're diversified in a concentrated portfolio. It also means we can point our research efforts where we need to do more work, whether it's a theme that we haven't researched or one that we would like to gain more exposure to, should valuations make sense. So the importance of this framework is paramount to us in terms of ensuring that we position our clients' assets on long-term, attractive structural growth opportunities and that we have a good visibility on the extent of that exposure. Let's zoom in on resource scarcity. If you look at resource scarcity, we define resource scarcity not just as natural resources. Yes, water, food, and energy feature in there as resource scarcity. But we're also defining physical resource scarcity. So infrastructure is a type of resource scarcity. Education is a form of resource scarcity. So we've got that featured in there. And indeed, access to capital or finance is a resource scarcity. So lending and investing is within that. And finally, human capital is also a resource scarcity, certainly very acute in some aging countries like Japan. And therefore, robotics and automation are a theme that appears here. And the importance of this for us is to ensure that we're well aware of where we're exposed to what is a very critical area of investing, where we see a lot of opportunities, but that's also at the heart of both climate change, therefore decarbonization, and the innovative opportunities that there are to decarbonize economies feature in there. I'm going to go through electric vehicles as one example in a moment, but I just wanted to highlight a few things. Food scarcity, for example. According to some estimates, as many as 5 billion people, particularly in Africa and South Asia, are likely to face shortages of food and clean water in the coming decades due to climate change impacts and shortages of arable land. On the water scarcity side, within the next 5 years, an estimated 1.8 billion people will live in areas plagued by water scarcity, with 2/3 of the world's population living in water-stressed regions as a result of use, growth, and climate change. And if the degradation of the natural environment and the unsustainable pressure on global water resources continue at current rates, there are estimates that show that more than 5 billion people could suffer water shortages by 2050 due to climate change, increased demand, and polluted supplies. All of which really highlights the importance for every corporate, for every investor, and for every consumer to focus on sustainability as part of ensuring we put our clients' assets on viable long-term business opportunities. On the electric vehicle side, which is an important area, we forecast 30% growth in electric vehicles over the next 10 years. This is an explosive growth, as we highlighted before. Our approach when we analyze an opportunity such as this one is to look at the whole ecosystem, to make sure that we capture the best opportunities across the whole value chain. So when you think electric vehicles, don't just think car manufacturers. Think about the lightweight materials that go into those, the technology and connectivity kits that are the components of the car. Or in terms of charging stations, grid and infrastructure, and the whole economics around that. Or of course, the batteries, battery manufacturers, and the materials that go into those batteries. And what we find is that we want to find pockets, niche areas within this value chain that have less competitive pressure than at the forefront of the consumer, which is where the car manufacturers are, that operate in niches and therefore where there's barriers to entry, which gives these companies more pricing power and therefore higher returns. And importantly, that means that we don't have to run the risk of consumer choice, and we don't have to make a call on which car brand will have a bigger share of the electric vehicle market than the other. Instead, focusing on capturing companies that sell to any car manufacturer throughout the world, giving us that ability to capture that 30% growth compound to 2030 that we estimate. And the same holds for Apple. Those of you who are familiar with the Global Portfolio Trust will know that we have had strong performance over the past 2 to 3 years. This has been achieved without owning any of the FANGs. So we don't have Apple in the portfolios, but we're able to capture the Apple ecosystem in the same principle as with the electric vehicles, by being exposed to the value chain, which gives us at times companies that actually grow much faster than Apple and generate similar or at times higher returns to Apple, but importantly gives us that exposure to the Apple ecosystem without the risk of competition that Apple is facing with its very strong competitor being Samsung. We're going to mention a couple of things on Outlook because for us, the pandemic crisis has indeed, as for everyone else, been unprecedented, but it is opening midterm opportunities that we've highlighted in our Outlook report at the start of the year, and which, when we look at the next 5 to 10 years, have actually shifted some of the structural growth dynamics. So firstly, on the geopolitical risk, what we wanted to mention here is that geopolitical risks are going to be ongoing, and we're highlighting them there. But with the Joe Biden presidency, the dynamics are going to be more constructive and less unpredictable, which in itself should be a positive for markets in terms of removing some volatility. We're highlighting on the left some of the market risks that we foresee at the moment, the low yields environment, which is a challenge for investors, but which is actually providing support for equity markets. The gross value valuation spread, which is something that has been quite apparent over the last few months, and the risk of rising interest rate expectations, even if central banks are very clear in their message that they're not going to raise rates for the foreseeable future. For us, in terms of outlook, we're looking at gradual recovery rather than V-shaped recovery. We're looking at a lack of sustained inflationary pressures beyond the frictional inflation that we should be seeing over the next few months, and the base effect that should help inflation on a year-on-year basis. We also wanted to highlight the increased indebtedness, which should lead to higher tax rates. We've already heard the Chancellor talk about that. The risk of pandemics, relapse risk, which is important to bear in mind. Europe is particularly hit, continental Europe, and there could be risk of additional relapses further down the line. And then finally, policy initiatives are so critical to the recovery that timing of the recovery and magnitude of the recovery will be very much dependent on how rapidly these policy initiatives make their way into the real economy. So something that investors need to continually bear in mind. So for us, in terms of midterm opportunities, infrastructure is key. And infrastructure is going to be an important long-term driver given the magnitude of the stimuli that have been unveiled globally, equivalent to about 15% of GDP. Some countries like the US even more so. And what we think is they will be channeled in various areas which we are highlighting. Firstly, renewable energy. That's one area, so green infrastructure. Electric transportation, electric vehicle and high-speed railway being another one. We think there's going to be 5G telephony as another one, so a form of infrastructure, telephony infrastructure. And this one in particular is exposed to the geopolitical dynamics that we highlighted previously. Healthcare infrastructure is another one. No government will come out of the pandemic crisis without a need and an intention to increase spending on healthcare. And we think there are some interesting dynamics there in terms of digitalization of healthcare in particular, with some very attractive opportunities. And then we think corporates will be focusing on strengthening their supply chains and their production lines post-pandemic. So robotics and automation, or an increased investment in robotics and automation, will be an important thematic. We've seen that more businesses have migrated online during the pandemic, so cloud computing as a trend has accelerated. And within that, of course, cybersecurity as an important area of focus to ensure resilience and that companies invest properly against the cyber threat. The last two, online education being an important one, as well as online gaming, which was a trend that was already present, but that might have accelerated since the pandemic. And finally, hygiene, both food and domestic and professional premises. So a lot of attractive potential long-term trends that have either been accelerated or have been triggered as a result of the pandemic, which we see as important areas of research and potentially of stock ideas for the trust. Very quickly, we're highlighting the top 10 here, so something that we can come back to, but really the message here is very high conviction concentrated portfolio with a good array of businesses across different sectors such as technology, healthcare, industrials, and consumer, as well as across geographies. An area to highlight on the left-hand side of this table, of these charts, is our exposure, which is balanced between four important areas: healthcare, technology, consumer, and industrials. We've got no exposure to energy, utilities, real estate, very underweight financials. We don't hold any banks in the trust. And on the right-hand side, you can see our big underweight to the US equity market, 15% underweight currently. And at the bottom, you can see generally overweight by 20% in market caps of 10 to 30 billion. The aim for us is to capture for our shareholders and investors the future quality growth companies of this world. Performance has been strong. We're really pleased. We were best performing trust in 2019, and we managed to make it onto the podium in 2020, a podium that was always going to be occupied by our friends and neighbors that have had a stellar performance, and we wanted to congratulate them on what has been a terrific year of performance for their shareholders. Here we're seeing just the performance on the left-hand side since I took over the trust, and on the right-hand side over the longer period. So we're really pleased with how the momentum in terms of performance of the trust has continued to develop and continue to deliver strong returns for our shareholders. And this concludes my presentation. David, back to you.
And another reminder to post your questions and comments into the box, or share them on social media using the hashtag Scotsman Investment 21. I'll hand over now to David Coombs, who is head of multi-asset investments at Rathbones. And David is going to pick up on one of the themes Zed touched on there in much more detail as he talks a bit more about, particularly about the healthcare sector within some broader trends. So David, over to you.
Good afternoon, everybody, and thank you for joining us and me for this afternoon's session. First of all, slightly disappointed to be following a Frenchman, Zed, after the Grand Slam failure of last week by my, as you can see from the cushion behind me. It's been a difficult week or so. But thank you to you Scots, who certainly ended the week for me on a high point. But back to the subject that I'm going to talk about today. And I thought, really, I'd focus on one particular sector, and that's the healthcare sector, which is obviously quite topical given the current situation. But this is actually a presentation I put together over a year ago. And you might think, well, that's cheating. I have updated it slightly, so it's not totally lazy. But I think what's important is that, like many trends, nothing has really changed, and yet everything has changed over the last 12 months. Most of the changes to the economy and to the world that we live in were already happening, whether it's e-commerce, online gaming, etc., etc. So what COVID has really done is exacerbate and accelerate many of those trends that we're already seeing. So 12 months ago, I would have been talking about, aging populations, birth rates falling in the West, health deteriorating, the rise of obesity and diabetes. I mean, it would have been a cheerful presentation, clearly. But all of those things have just been exacerbated, if you think about it, by COVID. The two cohorts the most at risk through COVID have been the elderly and the obese. And many of the deaths, unfortunately, have come from people in either experiencing obesity or, as I say, in elderly groups. So it's a healthcare crisis. And yes, we had a stock market sell-off last year, and people said it was a risk-off episode. But what it was really about was a healthcare crisis and the world trying to understand how that was going to work on the real-world economy. The last crisis, of course, we had was in 2008, the global financial crisis. And I'm going to draw a parallel, and you might think that's a bit odd, given one's healthcare and one's financial services. But think about what happened after 2008 to the financial services sector. Huge change, which the industry is still sort of kind of dealing with today. The banks, look what happened to RBS, for example, up in Scotland, and some of the other retail banks across the northern hemisphere. They're still paying extra taxes. They're still having governments telling when they can't pay dividends, etc. You could argue the shareholders in particular are still paying for some of the excesses of the banks prior to 2008. Now, you might argue some of those individuals involved got away with it. I might not disagree with you. But as a sector, it is still 12, 13 years later coming to terms with that event. It is my argument that in the healthcare sector, we're going to see something similar after we come out of COVID, which hopefully now is not too far away. Obviously, we're in the middle of a pandemic, and we're finally coming to an end of it, hopefully in the UK and the US, where we're seeing the rollout of the vaccine. It's a big success. But one thing that's been very clear during the last 12 months is that the many healthcare systems, whether they are the NHS publicly funded in the UK or whether they're privately funded in the US or hybrids across Europe, many healthcare systems have struggled in dealing with the pandemic. And we still don't really know what the impact has been or likely to be over the next 12 to 18 months. How many illnesses have not been diagnosed because people have stayed away from hospitals or GP practices? What are the waiting lists going to look like? What is recruitment going to look like in the industry over the next 12, 18 months? One thing we know is the repercussions of COVID within the healthcare systems. And like I say, it doesn't matter how it's funded, they're all going to be facing the same issues. Again, can we move the slide on, please? So I'm going to focus on the UK to start with. And of course, the NHS, which is hugely popular with the electorates in all across the UK. But of course, it's often been used as a political football by all parties. All have been guilty of this. We're seeing it now with sort of closer to home with pay for nurses in Scotland, just on the eve of an election. Constantly politicians, whether it's Brexit referendum, have used the NHS as a kind of crux in which to get voted in. And unfortunately, what this has done and all the reorganizations that have happened have really meant we haven't focused on dealing with the issues. How are we really going to pay the staff more, the clinical staff more? How are we going to be able to afford an aging population with more people requiring care and people getting less healthy? Most of the time, the answer just seems to be like the side of the bus, just add loads and loads of money and somehow that'll go away. Well, let me be very clear. There will never be enough money to sort this problem. If you think about one of the biggest effects and mistakes, if you like, in the UK last year was moving many elderly patients out of hospitals into care homes that aren't under the umbrella of the NHS. And the amount of people who died within care homes unprotected was really quite shocking. And that's, of course, because social care in the UK has never been part of the NHS and funded nationally. All of this will have to change. And like I say, there will be governments across the Northern Hemisphere and probably the Southern Hemisphere. They're going to have to tackle this going forwards. Next slide, please. I sound like Chris Whitty. So how are we going to do this? As I've just said, it's not going to be about just throwing money at the problem. We've been doing that for decades, and the problem just keeps getting worse and waiting lists keep getting longer. Now, what we're going to have to do, and this is going to sound quite controversial, we're going to have to increase productivity in the healthcare systems. Now, before you throw your arms up in shock and start throwing things at the screen, what I don't mean by productivity is for profit or turning into the private sector. This is not about how a healthcare system is funded. If we are going to improve the pay of nurses, we are going to have to reduce the amount of staff that we need and to train those staff better, not charge them for it. To do that, we need to make sure the money is spent better elsewhere in the system, not on administrators and managers. And how do we get rid of administrators and managers? And how do we make sure that fewer clinical staff see more patients? There are two key answers to this question. And these two key answers are one of the ways I think through investing ourselves, we can help. And that's in medical technology improvements. It's also through the prevention of people getting ill in the first place. And that's not going to be easy. And of course, we hear about sugar taxes, but let's think about that, right? You know, taxing on tobacco didn't work particularly well. People started reducing smoking when we started banning smoking in public areas or in pubs and restaurants, etc. And again, I know that wasn't overly popular, particularly with smokers. But maybe we're going to have to see much more revolutionary ideas coming through in how we deal with this going forwards, because we can't go on as we do. So let's talk about prevention. How can we prevent people getting ill in the first place? Well, the first thing, of course, is more testing and early testing. If you think about it, think about your car, okay? When your car becomes 3 years old, you think you have to have an MOT certificate. We think nothing of it, 50, 60 pounds, whatever it costs. Maybe a bit out of touch, haven't done one for a while. But we don't think anything of it. We do it, we pay it, and we get a certificate saying the car is still roadworthy. Yet we don't have to do that about ourselves. What if we had to do an MOT, I don't know, once every 3 years, the under 40s, once every 2 years, the under 50s, once every year under the 60s, etc., etc. Because if we give everybody an annual medical or biannual medical, then perhaps we'll pick up diseases or conditions much earlier before they need treatment. Imagine the savings. I myself had a medical condition was picked up by an annual medical that prevented me becoming ill in later years. I've seen it happen for myself. That was through my company scheme. It was, of course, private. But what if we did that across the country? Yes, it might sound expensive, but the savings would be huge. Part of that prevention, of course, is through testing. And one of the areas that we can invest in is laboratories and companies that specialize in diagnostics. You know, we invest in Abbott Labs and Eurofins, for example, in our portfolios, which actually were able to repurpose their labs during COVID into COVID testing. And once healthcare systems realized they couldn't cope on their own, they outsourced to these companies. And that helped our portfolio be more resilient during March and April of last year in particular. But I see medical testing being a big growth industry. It's going to have to become more efficient and deal with more volumes. But of course, those laboratories are not easily put together. They're expensive to develop. They can take a long time, and you need specialist staff. This is not a low-cost enterprise. It's a very specialist enterprise. And those companies that have been investing in that equipment over the last 5 years or so have a significant advantage with huge barriers to entry. So this is a way that we can invest in prevention. It's one side. The other, of course, is through investing in companies developing new foods which are much healthier. Some of those have gone up in price a lot over the last few years as part of the whole ESG phenomena that Zed was talking about. And one needs to be cautious there. You know, we invest in companies like Christian Hansen involved in natural food ingredients, because I think there will be greater demand for good tasting food that is good for you, rather than just eating a damp lettuce leaf, which my grandparents used to do whenever they were on a diet. I think there's huge growth in that area. We'll have to be cautious. But I want to build up a portfolio of companies that are involved in helping educate and prevent illness going forwards. So that's one way that we can look to prevent and reduce costs. The other is to improve productivity, as I say, within hospitals and other health institutions. Now, I'm going to go through a few slides now, and some of it, I'll be honest with you, is quite blue sky thinking. Some of it may be hopeful rather than reality, but already based on technology that exists and how it may be applied. Firstly, the use of robotics already is used in many procedures, reducing the time of operations like knee surgery through companies like Stryker and Smith & Nephew, and hip replacements. But the use of robotics will increasingly become part of routine surgical procedures. What if we could have surgeons operating on more than one patient at once in 2 different locations at once? What if we could have surgeries operating 24/7 rather than being dark for 12 hours a day or only operating 5 days a week? If we could do more surgical procedures per day with less number of people in those theaters with more shifts, then that's going to be more efficient. We get waiting lists down, we get costs down, and that's got to be a way to invest. If we can help those healthcare systems by investing in companies who are innovating in these areas, that's good for us as investors, but it's also good for us from a society point of view as well. Next slide, please. Even in wound management, can you believe it? There's even technology innovation here. Unlike the 1920s photograph on the left, which was kind of innovative wound management in the 1920s, fortunately, we've moved on. There are some wound systems now developed by Smith & Nephew, for example, and some of their competitors that can be left on the patient for over a week that improves the hygiene to reduce infections, but also reduce the time taken for those wounds to heal. That's great in terms of patient outcome. The patient gets better quicker and is less likely to suffer from infection. But also that dressing only needs to be changed once a week, not once an hour or once every 2 hours. Again, everyone wins here, right? The patient wins through a better outcome, and the healthcare system wins because it's less cost to apply. And that just goes to show it doesn't have to be high-end, in robotics and artificial intelligence. It can be something as simple as just wound management. But it's having the will and the political will to embrace the private sector, even within, yes, the NHS, because that is how those nurses will get better pay. Next slide, please. I talked about the social care system as well for the elderly, and also localized hospitals that are being shut down. It seems to me that patients would rather stay, or let's not call them patients, or people in getting towards the end of their life would rather stay at home for as long as they possibly can, rather than sitting in special hospitals, miles away from their family in some instances. I see a world of virtual hospitals using sensor technology and the Internet of Things, with, like the chap in the left-hand corner there, sat in front of a bank of screens, a bit like the guy in the shopping mall looking at screens for security purposes, but working in a local hub, maybe a local GP practice, wired up to a lot of the elderly patients within a relatively short walking or even cycling distance from the hub, where they can treat them and go and see them on a needs basis, rather than just on a routine 9 o'clock till 10 o'clock every day, or once a week, when it's only a matter of luck or not, whether that patient needs them at that time. Again, imagine the savings that we could make in the system, but also think how much better it would be for people to be at home and near their families. And if we can, again, invest in areas that both sides win, then that's got to be attractive. Next slide, please. But of course, with any technology, it's no good just throwing money at the wall. There are lots of ETFs that specialize now in these areas. But I remind you from this slide, we saw lots of technological innovation over the last 20, 30 years, which looked great. For those of you who are old enough, and those that aren't, you may have to YouTube this, but Betamax was a big failing, although it was a better technology than VHS. But also the Sinclair C5 on the right-hand side, again, you might need to YouTube that. Lots of great technology ends up losing lots of money. And even the medical technology space, that's also we've seen the same sort of things. Theranos being one of the biggest example of this in the last few years. There's a book called Bad Blood, which I'd recommend you read, which is a real sharp lesson in the risk of investing in innovative technologies and how fraudulent people who can raise millions, if not billions of dollars for R&D can do so through the cloak of bringing people around them who are famous and people trust. Does that sound familiar in the UK at the moment? I mentioned no names. The latest scandal is a company called Ubiome, which again is DIY testing at home. I won't go too much into details, we've just had lunch, but again, it's another fraudulent fundraising. The technology just doesn't work. So we have to mind our eye here. It is a higher risk area to invest in. So again, we invest in much larger cap companies, which yes, are doing innovation, but already have got a track record improving. Next slide, please. And what I don't want to do is kind of blight them with some really clever acronym that suddenly gets hyped up, because I think those things are very, very dangerous. But I think there are a number of companies that one can invest in, household names, and I don't own all of these, I own some of them, which we can invest to get exposure to some of these themes that I've been talking about. Thermo Scientific, which we do own, one of the kits out many of those laboratories and theaters that I've been talking about. Stryker, that makes robotics for hip replacements. Abbott Laboratories, one of the leaders in diabetes treatments. We also own Dexcom, for example, which has even better technology, if you like, than Abbott in dealing with diabetes pumps and alert systems. Are these the fangs of the next 10 years? I don't know. It doesn't really matter. But I do think this sector, and as I said, these are very large cap companies. We're not taking risks in venture capital here, although of course one can do so. But they have a track record, and importantly, they have the capital and they make profits. Let's not forget that's pretty important. That we can invest and feel relatively comfortable that we're in safe hands. And I think this is one of the most exciting themes for the next 5 to 10 years. Next slide, please. So in conclusion, healthcare has a number of interesting points that lead me to recommend it to you today. Notice I didn't mention pharmaceuticals particularly. Pharmaceuticals, of course, produce drugs, and they have to maximize the price of those drugs to meet the R&D expenses. So whilst they do, of course, help with vaccines and help cures, ultimately they're price takers from governments. I focus on the other side, investing in companies that ultimately will save money for governments and healthcare providers. Yes, their kit may be expensive up front, but they will help save costs over time and help save staff and help to focus expenditure on clinical staff rather than support staff. And you have got trends that support this. Aging populations are not going away. Again, the birth rate in the UK is near lows over the last 12 months. So the demographics are actually in our favor. This is part of responsible capitalism, and we will see capital come into this sector. Now, some of it, as I say, will not always go to the right areas, and we need to be careful. But I think, this movement in AI and robotics in healthcare will be like the fourth industrial revolution. It really will. At the end of the day, we've got to look after our elderly, and frankly, as Warren Buffett on the right, he's not getting any younger. We've got to look after old fund managers like myself. And so I'm investing to look after myself in 20 years' time. I'd like you to join me. Thank you very much, and look forward to taking your questions at the end of the session. But in the meantime, and again, apologies for the slight tech blip, and I'll hand you back to David.
Thanks very much indeed, David. Our final speaker is Iona Bain, a young money expert whose book Own It was published this month, and she's going to talk about its core theme, which is how young people are investing themselves to a better future. Iona, the virtual floor is yours.
Thank you very much, David. I'm really pleased to be joining the Scotsman Investment Conference this afternoon. And as David said, I have just written a book all about young people and why they need to invest, and trying to provide them with some advice that they can use to really start their journey in investing in a wise way. So as you can see from this first slide, this is what I'm going to discuss over the next 15 minutes or so. And whilst I'm going to talk a lot about some of the dangers and the risks for young investors today, I'm going to end hopefully on an optimistic note. So let's get into it. Whichever way you cut the data, you'll see a significant increase in the number of young retail investors entering the market in the past year, and they are now a real force to be reckoned with. So this graph, originally from Bloomberg Intelligence, reproduced for the Financial Times, shows that retail trading volumes are almost matching that of mutual funds and hedge funds combined. Now, this graph purely refers to the US, and it's fair to say that the retail trading boom is much more vigorous over there. And there are lots of factors to explain that. It's partly because the US has always had a stronger share trading culture among the public. More ordinary people, if you like, in the US report that they own shares in relative terms compared to here in the UK. We tend to obsess much more about housing as an asset. It also helps that the US market is one that has been on a stellar trajectory until very lately, dominated as it is by high growth tech shares that have really found favor in the growth environment of the past 10 years or so. And that's created this very favorable environment for young people in the US to start investing on their home turf, if you like. And that's been boosted by the surprising and some might say worrying bounce back in the US market last year, one that seemed unconnected to the overexpensive valuations and obviously the economic damage caused by COVID. Although when you consider just how much of that growth was fueled by a small number of tech companies and how reliant we were on them during lockdown, maybe it's not so surprising after all. Another big factor, of course, was the so-called stimmies, as they're called online, but to you and me, they're otherwise known as stimulus checks, which are the payments that are currently being sent to Americans who've lost out as a result of restrictions. And many of those recipients of stimmies are putting the money towards investing. So they feel like this is not necessarily their money that they're risking in the market. They feel like it's a nice bonus that they can use and put it into investing and hope for the best and see what happens. You also have the Robin Hood effect. Robin Hood, as I'm sure many of you know, is the most well-known so-called free trading app in the US. With free trading, the business model lies in making money on the spreads, but you don't actually charge the customer to buy and sell shares on your platform. So this is a business model that's really grown in popularity in recent times. And Robinhood as a business is more established and well known than comparable businesses here in the UK like Free Trade and Trading 212. Nonetheless, as with so many things, where the US goes, we tend to follow. And that's particularly the case with the younger generations who are very internationalist. They may not be physically traveling the world at the moment, but they're certainly consuming information from all over the world, but particularly the US. And they are getting a huge amount of information from influencers on social media. In previous eras, you might have only found out about market moving events from relatively slow news in the newspapers and on TV, with only the most involved retail investors checking market movements regularly and reading the Financial Times and so on. Now, Elon Musk tweets something and your son or daughter probably knows about it before you do. So news of an investing phenomenon like GameStop can reach a young person here in the UK directly on their phone within hours, if not minutes, of it taking off. So that's how much the investment landscape has changed, even in the past 10 years. So this new investing enthusiasm or fanaticism, in some cases, is proving very infectious here in the UK. I could have chosen any number of surveys and pieces of research to demonstrate that enthusiasm for investing among younger people. This is just one of them. It is a piece of data from the personal finance website Finder. They conducted a survey during the pandemic, which found that 75% of Gen Z and 74% of millennials are expressing an interest in investing during the pandemic, compared to 60% of baby boomers. And I think that is broadly confirmed by other pieces of research out there. There are factors here in the UK that we share with the US that explain this young investing boom. So, for instance, the obvious main factor is that young people have been very bored during the pandemic, deprived of their usual activities, sat at home. They've taken to investing really as a hobby in many cases, and as a way to introduce some excitement into their life. So let's just dig a little bit deeper and see the more complex motivations that are at play here in the millennial investing revolution, because we can, easily say that it's just down to boredom and people looking for a bit of excitement. But I think it merits a closer examination. Fortunately, the Financial Conduct Authority did some very in-depth research with an organisation called Britain Thinks. They published that research paper last week, so we can get some really good insights into what younger people are thinking and feeling when it comes to investing. And on the plus side, it found that a younger, more racially diverse group of people are getting into investing. On the downside, it found that too many of them are not going into it with their eyes open. They're not doing a lot of homework, and they're tending to follow influencers, trends, and their gut instinct. So this slide here demonstrates, first of all, at the top, the factors that are motivating investors and how there's a difference between younger investors who are really drawn to high risk, high return schemes, often being promoted by influencers online. The difference between those investors and people maybe who are a bit more experienced and know that that these things can be too good to be true, and therefore are more cautious and steady in their investing strategy. And the difference is that if you tend to be more cautious and steady, if you're not drawn to those high risk, high return schemes, you tend to be motivated much more by what the FCA called functional reasons to invest. We're talking about just really outpacing inflation, achieving enough money, achieving enough of a return to fulfill your long-term goals, that sort of thing. However, if you're drawn to the more high risk, high return investments, and that's what a lot of younger people are drawn to at the moment, you tend to be motivated more by emotional and social factors. The emotional and social factors can be really varied and quite fascinating. The FCA talked about a kind of lust for novelty and thrills and excitement, but also a feeling that investing could be turned into a big hobby and almost a social status to be proud of. And some of those motivations are more positive than others, shall we say. But we really need to bear in mind that for young people today, the kind of boring considerations that we often talk about with investing, they don't register with a lot of younger people. For them, it's a chance to play in the big leagues, to use the phrase that was quoted in the FCA research. So I think it's really important that we understand that. Also, at the bottom of this slide here, you'll see that these are two archetypes that were identified by the Financial Conduct Authority in this research. So the first archetype is the young investor who's having a go. They're going to try to use shortcuts to get results. They are more reliant on social media and video than on the traditional media, and they are motivated by those emotional factors that I spoke about before, such as novelty. The second archetype that the FCA identified was the thinking it through group. These are typically more experienced, and they tend to have their rules of thumb that they follow, and they dedicate a lot of time to investing as a hobby, and they tend to see themselves as investors. That's very important to their identity. However, there is a danger there in that they can overestimate their abilities. The group that I think is most concerning is this one, the gambler archetype. Now, these are also more likely to be newer and or younger investors. And they have a much greater level of confidence than those in that first group I mentioned, having a go. And what's more, they are going beyond just cherry picking shares that they think are hot at the moment, like Tesla. They're going beyond that and investing in contracts for difference, Forex, investments that are very risky and maybe not very suitable for beginner investors. And they're highly driven by emotional and social motivators. Now, here I also include a quote from the Financial Conduct Authority research to illustrate the fact that a lot of these younger investors are not very well disposed towards traditional platforms. So, I mean, here in the UK, we have definitely seen all investing platforms. There's definitely been an uptick in the number of young investors opening accounts on platforms. So, for instance, the average age of new clients who have opened accounts with Hargreaves Lansdown, the UK's biggest platform, that's fallen from 45 to 37 since 2012. So the average age of retail investors in the UK is coming down, and that trend's been seen right across the platform industry. However, the FCA research found that more than half of young investors who had been investing for less than 3 years tended to prefer newer platforms, compared to 39% of more experienced DIY investors. And this quote maybe explains why. A lot of younger people feel like these platforms like Vanguard are not for them. Whereas when they sign on to an app like Trading 212, these platforms clearly know how to make their service much more accessible and easy to use for that younger generation. So I want to talk a bit about the platforms that are really capturing the imagination of younger investors in the UK. As I said before, UK platforms such as Trading 212, Free Trade and Revolut, they're not taking off in the same way that Robinhood has in the US, but I think it's only a matter of time. They have very savvy marketing that is aimed at that younger generation. And here I include on this slide a sample of screenshots from the websites and social media feeds of some of these newer platforms. So most of them discuss well-known brands. They'll sort of flash the icons of Apple and Netflix and Facebook and Tesla at new customers. And they talk about these brands a lot in their marketing. In fact, pretty much every new platform these days has a slogan such as buy brands you love. It will be some variation on that sentence, but basically they're all encouraging younger people to buy the brands they love. Now, on the one hand, this is a very shrewd way to engage young people with investing. And it makes sense in some ways because ideally, when you invest, you should invest in what you know. You want to be engaged as a shareholder. You want to feel happy and comfortable that you're investing in companies in your portfolio. But the concern is that this whole buy brands you love narrative is distorting young people's perception of what investing should be like, that it's causing them to overlook and ignore those stocks that aren't sexy high growth tech companies, but that nonetheless have a lot of merits. And the other advantage of new investment platforms is that they're dramatically lowering the market barriers to entry, because I can open a free trade account and pay 0 fees if I want to, with the caveat that I would have to have my share buying executed at 3 p.m. In bulk with the other customers, and some shares are behind a paywall. But nonetheless, it's possible for me to go on that app today and buy some shares at no cost, unlike with, say, Hargreaves Lansdown, which comes with a range of fees. So that makes investing easy. That's good. Does it make it too easy? Does it create an expectation that buying and selling shares should be as simple as buying and selling a pair of shoes? And also, does it create the expectation that really you should be able to make money in a short space of time, that consistently high returns can be guaranteed? And I think in their desire to make investing accessible, some of these newer platforms are painting it as a fun game. So a lot of them now offer kind of league tables and fantasy investing. Nothing wrong with that in itself, but sometimes they can come up with some really, very, very outlandish projections for what people can achieve, like, 20%, 30% in a month. And I think this encourages behavior that feels more like speculative gambling as opposed to informed and calculated investing. And so I think this is the Robinhood effect starting to play out in the UK, because Robinhood has certainly come under a lot of scrutiny in recent months about the kind of behavior it encourages among its younger investors. And very sadly, I do think that this can have tragic consequences. Alex Cairns took his own life last year. He was a Robinhood customer. He was just 20 years old. This was the question that he wrote on his computer before that happened. He thought he had racked up thousands of dollars worth of losses trading derivatives. And he questioned how he'd been allowed to do this at such a young age with no experience, as did many others. Now, Robinhood has tightened up its procedures. It also donated a very large sum of money to the American Centre for the Prevention of Suicide, but it scrapped its launch in the UK. It's come under a lot more regulatory scrutiny. And I think this whole episode shines a light on the dangers of making very high risk trading options available to young investors who don't have very much experience. And in my book, I talk about the fact that if you make a lot of losses early in your career as an investor, you can actually go on to develop post-traumatic stress disorder. There are lots of mental health implications of investing that I don't think that we're talking enough about at the moment. Nonetheless, I do think the millennial investing revolution is only going to continue. I don't think it's just a blip as a result of lockdown boredom. I think that now a lot of young people have, have really started that habit and are going to continue it for various reasons. Young people are realizing that interest rates will probably continue to be very low for some time to come. And they also think that the current crisis presents a rare, maybe once in a lifetime opportunity to get in at the ground floor of the economic recovery and play their part as shareholders in building back better. And I think they're also making their influence felt in the debate on ESG. They are making it clear that they have higher expectations of companies and that they want to see them try to exert their power as institutional investors to push forward progress on things like climate change. And also they're taking advantage of an increasingly competitive robo and DIY investment market. It's no longer the case that if you can't access financial advice as a young person, then that's it. You won't be able to get help anywhere with your finances. We now have a lot of robo advisors who are reaching out to that generation. And free trading could become a really disruptive force for good in the UK investment market. It could challenge the dominance of platforms like Hargreaves Lansdown and others that have ruled the roost with high opaque fees for too long. And I also think the lifetime ISA, which is available only for the under 40s to save into, presents a rare opportunity to invest for the future with a massive bonus from the government. But this brave new world comes with risks. I feel too many young people are drifting towards the big tech giants and brands they love without considering how to manage their risks and diversify properly. I think they're also following the crowd too much. They're egged on by apps and influencers online who may be focusing on big, sexy international brands and cryptocurrency at the expense of those more boring investments, which actually could be a much better long-term option for them. Trading apps with freemium models, which only offer a comprehensive universe of investments if you subscribe for a monthly fee, could push casual young investors towards a very narrow range of stocks and would therefore fail to provide that proper whole of market investing experience that they need. And I feel like there are so many risks in gamifying investments and making it feel like a fun, high stakes competition. And platforms that offer these complex and riskier options like derivatives and Forex, the risks there are self-evident. And I think that whilst these newer investing platforms have started out with good intentions to open up the market, I feel like there is a risk in due course that they may understand that they've opened a Pandora's box in a way. And also that they may start to move towards complex charging models that are just as convoluted as the traditional platforms. Also, we could see much more volatility in the market. We saw that earlier this year with what happened around GameStop, the US gaming retailer that was the subject of lots of short selling and then stock pumping by a community on Reddit called Wall Street Bets. I think that that's not the last time it will happen. I think we could see that happen again. We need to be prepared for it. So this is why I wrote my book, Own It. As you can see, this slide demonstrates the approach that I took when writing Own It. I filled it with really accessible, fun illustrations on the whole subject of investing, not by me, by a great illustrator called Rob Smith. And my whole intention with the book was to write the first British book explicitly about long-term finances, particularly pensions and investing, and one that's aimed squarely at young people. So it's based on the experience and knowledge that I've gained from speaking to both young people and the financial industry over the past 10 years. Now, the first part of the book is the why of investing, why we've struggled to own our finances, but also what opportunities we have as young investors, how we can use our power to really become shareholders in the system, to become stakeholders in the system, because there's a lot of frustration out there that we were left behind after the 2008 financial crash. But my attitude is, you've got to be in the system to affect any change. And I think we're starting to realize that with our greater involvement in the ESG debate, but we need to take that further. We need to take our finances to the next level. Also in the book, I deal with how we should think about issues like housing and pensions, because those are very big aspects of young people's finances too. And then the second part of the book is the how of investing, how financial technology has evolved since the 1980s, where we are today with investing technology. And I go through all the options that are available to young investors today. I talk about the pitfalls of the millennial investing revolution, Forex, the FANG stocks, and whether or not there's a world of investing beyond those, and also Bitcoin. I do a whole chapter on Bitcoin, which I think is quite brave, considering the fact that if you say anything against Bitcoin, you definitely get a lot of criticism these days, but I felt like it was important to address. And finally, the reason why I have this little illustration at the bottom of the slide here is because I actually shared my investing diary in 2020 to illustrate the things that went well and the things that didn't go quite so well in my first downturn as an investor. Let's just say that some decisions I made were better than others, but I wanted to share what I'd learned because I felt like that was the most authentic way to convey some very important lessons about stock market investing, such as the need to diversify, the need not to panic, the need to just stay cool and stick with your strategy come what may. And the thing is that we all talk about that, in good times when markets are relatively calm. The key is to really remember it when things start to get hairy, like they did last March, and like they did really throughout the whole of last year. That's why I felt like it was particularly important to share my investing diary from last year, to really embed those lessons and to crystallize some of the themes that I've been talking about throughout the book. So finally, I want to finish on a positive note. I do believe that the young investing revolution will continue, but I do believe that young people will perhaps come out of this period having learned some difficult lessons about investing, but that's no bad thing. And fundamentally, I think that the case for young people to invest has never been stronger. So firstly, I do believe that savings rates will continue to be very poor in order to keep borrowing cheap, and that will really compel young people to consider investing in order to grow their money. We know that the stock market has traditionally provided better returns than savings. Yes, predicted returns in the future may not be as strong as they have been in the past. We might be starting to see a real correction, a real turn in the markets from growth stocks towards value stocks. But when inflation is combined with low interest rates, we're still probably going to see parts of the market outstrip savings rates. And young investors are going to realize in due course that maybe they can't just bung all their money in an S&P 500 ETF, that they might have to look a bit further and be a bit more considered and think about those more promising areas of the market. This is, I think, a really good moment to start investing. I think, obviously, some parts of the market look really overpriced at the moment. You could argue that no parts of the global investing market are cheap in absolute terms, but there are certainly parts of the market that are cheap in relative terms, such as the UK. And I think that could present real opportunities for patient investors over the next 5 to 10 years. And also that gives young people a motivation, really. They can see that we need to do things differently, as David spoke about in his previous presentation, the fact that we have a broken healthcare system in this country, the fact that there's so much that is wrong with our kind of economic infrastructure. Young people are sensing that, And investing really is the best way that they can affect change. They're starting to understand that. And that's really the overriding message of Own It. It's that your money has purpose and power in the real economy. When you buy shares, you become a shareholder, you become a part owner of that company, and you have rights and a voice to shape the future of that company and the ability to vote with your feet if you don't like what you see. So if we're going to rebuild trust in our capitalist system, which, while flawed, is probably the best system that we're ever going to get, we've got to renew that shareholder culture. And young people can play a vital role in that process, particularly as investors in pension schemes, and more broadly shareholders who have got this idealistic outlook and want to see us making progress towards tackling climate change. So I do believe that if we want to build back better, we've got to put our money where our mouth is. Unfortunately, investing has never been more accessible and egalitarian, and therefore we really do have the chance to own it. So that's my presentation. I'm very happy to take questions. I'll hand back to David.
Thank you very much, Iona, and thank you to Zed, and thank you to David too. Iona, you, just to pick up on one of your points, first of all, you talked about the dangers of sort of gamifying investment. You talked about the need for younger investors for fast-paced decisions in a social media world. You talked about following influencers and so on. Isn't that just the world people live in, and isn't there a degree of inevitability about that, rather than them looking to those more boring investments because that's the way that people live?
I don't think it's inevitable that young people will only heed the advice of influencers online and that they will only gravitate towards those get-rich-quick schemes, or that they may become more short-term in their investing outlook. And actually, there was some research that was done last year by Finimize, which is an online investment community that's got kind of millions of members all over the world and is really gaining ground among young investors here in the UK. And it found actually that young investors are more considered than perhaps the headlines might suggest. So whilst that research that I talked about from the Financial Conduct Authority raised a lot of concerns about the mentality of young investors, I think it's important to stress that that might not be the majority. That might just be a minority that we should still be concerned about, and that might not be a lost cause. But the most young investors, either because they are going on platforms that are more balanced in how they discuss investing issues, or they're going to people like their parents and their grandparents, because actually the research also shows millennials and Gen Z get a lot of their information from their family, and that their parents and grandparents may be the most trusted source of information for younger people, especially in a world where we're becoming much more aware of fake news, and we're becoming aware of how the online world can be quite dangerous. So I don't think it's inevitable that younger people will kind of fall into that trap. We can't give up on talking to them about the sensible long-term investing strategies that really create that long-term prosperity.
Okay, thank you. Just to flip that on its head, David and Zed, Iona said that the older platforms, younger investors fell out of their depth, going on to kind of into the more traditional investment environments. How do the more traditional investment environments reach out to those younger investors, David and then Zed?
Well, I think this is about helping out education. You've got to get into the schools, and it's part of, and not just the posh schools, all schools, to get in there and help. It should be part of the curriculum, financial training, and it's up to the platforms, not just the platforms, but also the asset managers, the wealth managers, all parts of the industry, to do its bit into helping young people avoid some of the pitfalls, whether it's getting a mortgage, whether it's investing, anything to do with financial services. And we can all do more there. I don't think it's fair just to land it on the platforms, but they can certainly play their part, and then make them as accessible as possible. And to be fair, I think to Hargreaves and AJ Bell and some of the others, they are pretty accessible. Yes, they may not look like computer games, but I would argue that isn't the way to go. It shouldn't be, investment shouldn't be overly based upon entertainment, frankly. I think that's a very dangerous way to go. And I think the FCA should step in very quickly and shut these things down, because they do look like gambling sites. So I think this is a very complex area and needs the FCA and the industry to get together through education and through regulation.
Okay, thank you. Zed, a slightly different question to you. You talked at the very beginning of your presentation about Martin Currie, a Global Portfolio Trust, being a high conviction investor. When did your conviction waver most over the last year, and how was it about a year ago?
Yeah, it's a good question, David. The importance of conviction is to be deployed on a time horizon that is long-term, in our view. So it's important to really manage our clients' assets with that long-term time horizon. And on that basis, whenever we assess any company in the portfolio, we want to make sure that all of them that are in the trust are companies that we've got a high conviction in on a 5 to 10 year time horizon. And that conviction is a combination of valuation attraction, growth, structural growth, and attractive returns, either generated currently and continuing to improve, or over the lifetime of the forecast period that we assess them on. So to give you the example of last year, we walked into this pandemic crisis in a very much sudden way, unprecedented and unpredictable way. So in February, we had a portfolio of 30 names, all of which were high conviction. When the market really unraveled, and as a reminder, we had the fastest bear market in financial history since 1929 in the space of 3 weeks in March. And Iona mentioned that you have to not panic. It would have been very easy to panic. And for us, the situation was going to be dire in the short term. We felt this crisis was going to be temporary because it was an exogenous supply and demand shock simultaneously across pretty much all geographies globally. So we knew we were going to enter into a very rapid and deep recession, but that ultimately we were going to recover from that. So we had no activity in the portfolio in March. Likewise in April, in the space of 2 or 3 weeks in April, we had the fastest bull market since World War II. So it would have been very easy had you as an investor or as a portfolio manager, or indeed as a retail punter, taken action in haste. So the importance of conviction is to be deployed on that long-term time frame. And our question was always, has the business model been impacted structurally in the long term by this pandemic crisis and what we foresee as the world post the pandemic crisis? Or has anything else materially changed? If the answer was no, we're happy to continue to hold what were good quality structural growth businesses, well managed and sustainable. And we just stayed where we were, and actually it was the right thing to do.
Okay, thank you, Zed. David, what was your wobbliest moment of the last year? And you talked a lot about health tech. With so many companies jumping into the market and repurposing what they were doing towards sort of medtech and health tech, how hard is it to pick winners when there are so many new entrants into the market?
Yeah, I mean, there's two questions there. What was the wobbliest moments of last year? Well, March, April was pretty wobbly, to be honest, in terms of the market sell-offs, and markets hate uncertainty. And let's face it, the pandemic was the biggest uncertainty, certainly since the last uncertainty in 2008, I suppose. So that was pretty wobbly. Like always, the thing to test, though, and what we were doing during that period, and it's the same for the medtech sector as any other sector, the big issue that hurts you in any market correction or period of recession or uncertainty is leverage, is debt. Because ultimately, if you're investing in companies that have decent cash flow and a strong balance sheet and access to capital relatively cheaply, then yes, your share price can be quite volatile and go up and down, and yeah, that's uncomfortable and gives you a bit of a sleepless night. But ultimately, those businesses will survive and actually will probably come out the other side stronger as some of their weaker competitors fall away. So what we focused on in the healthcare sector, but also across the portfolios last year, was checking, what were the debt ratios looking like once the share prices had fallen, the market capitalizations of those companies had fallen, just making sure none of those debt levels were higher than we expected. And the reality was they weren't, because we don't like heavily indebted companies. But that would be my tip to anybody during periods of volatility. In fact, investing anytime, if you're a medium to low risk investor.
I think you've muted yourself, David, accidentally there. You're back. Yeah. Oh, no.
Lost my mic.
Yeah.
And sound.
I think we got.
You can hear me.
I think we got the main point there, David. But I'll just move on. Iona, there's a question in the box. If young investors are into ESG concerns and crypto in particular, how do they reconcile that with Bitcoin's energy consumption?
With difficulty is the answer. I have read arguments that suggest that actually the mining of Bitcoin is becoming a lot more eco-friendly. I believe that there's a part of China that is harnessing how to fuel mining with natural power. I think wind power, perhaps. I think that this is not necessarily representative of the sheer energy consumption that goes into mining. And I do think that younger investors are going to have to be as consistent as they can be. Although, having said that, ESG is an absolute minefield. I'm sure David and Zed can speak about the sheer difficulties of pursuing an ESG policy that will make all investors happy. And I think there's a real danger in having glorious ideals and therefore achieving nothing, rather than making real progress, albeit perhaps imperfect progress. Certainly, I do think that we have a lot of questions over how eco-friendly the whole process of mining Bitcoin is, and I address that in the book in a wee bit of depth.
Okay, Zed, you talk quite a lot about ESG. Which economic sectors broadly do you think are furthest down the line in terms of understanding of ESG? Which ones are maybe a bit slower to the party? And one of the questions in the box saying all those assessment data, when applied to a multinational like Unilever, for example, would give a really complex kind of patchwork of answers. How do you cope with that when you're looking at very big companies with the ESG data?
Yeah, good questions again, David. Thank you very much. So in answer to the first one, it's difficult to think of any sector or company that isn't now aware of the importance of putting ESG within some of their strategy and certainly their communication. The risk, of course, is that some of these companies then are guilty of greenwashing or of channeling messages that their users, their investors, and customers might be willing to hear, rather than them genuinely believing in the ESG. So for us as investors, the importance of having a very detailed structure assessment like we do is to really go into the very detailed assessments so that we make sure that we are comfortable with the governance and sustainability of any of those businesses. And therefore, in answer to your second question, which is on Unilever as an example, indeed, it can be very complex to go into the detail, but it's absolutely critical to make sure that we have a good, structured, fundamental assessment of any of those businesses. And it's what we call really the essence of our work, the research work that we do on every company. Because we're high conviction and concentrated, we only have a short list of companies that we need to do the work. But only by doing the work can we then get comfortable and therefore have conviction in some of these businesses. So it brings another aspect, which is there are areas, there are databases out there that try and assess companies' ESG scores and approaches. And unfortunately, some of them are very relying on artificial intelligence. So really looking for word searches in annual reports, in sustainability letters from the chairman or the CEO. And because every corporate is well aware of the importance of talking about ESG, those letters often have the right messages. The importance of the work we do is moving from the messaging to the actual assessment of the actions, ambitions, targets, and how they're deployed and how they're achieved. And that's why, to us, it's very important to have a structured ESG framework that make us able to discern from companies that just talk and the companies that actually act on their talks.
David, similar question to you. How do we identify those companies who are just talking the talk and not walking the walk? And also, just in that healthcare sector, you had that picture of the guy looking at the bank of screens. When it comes to sort of diagnostics and monitoring, sending imaging, Internet of Things, what about those privacy considerations? Is that always going to be a kickback?
Yeah, so one of the biggest risks to the Internet of Things, of course, is cybersecurity and privacy. And this is one of the conundrums that we're going to have to tackle over the next 10 years. And you're already seeing the repercussions and more inshoring of manufacturing of high-end goods back into like the US and to Europe, away from China and other emerging markets, because of some of this sensitivity. You think about the whole Huawei issue, that's all linked to this. So absolutely, you know, as our homes become more wired into the Internet of Things, we become more worried about people interfering with our grocery order from our smart fridge, right? We end up with a whole fridge full of avocados, and no one needs that. So yeah, it's a massive issue, and within healthcare, that will be a worry. And governments haven't always been particularly good with our data, right? So it is a challenge, and we do invest in a company called Accenture, for example, that helps corporates deal with cybercrime. So there's an investment angle, but it's one of the biggest risks to any corporate. And data security is one of the key criteria one looks at, but there are no guarantees. To answer the first question about walking the walk rather than talking the talk, it's a big issue. And I think, you know, greenwashing is a very clear and present risk for investors to face. How do we deal with it? You have to meet the companies. You have to be in the room. Okay, you've got to engage and not publicly and throw insults around. It's actually having a constructive dialogue with those companies. We have a specialist subsidiary called Greenbank within Rathbones that help us do that with analysts who do this all day. You don't just want to talk to the head of ESG that's wheeled out with a nice PowerPoint presentation. You've got to get in there into the weeds, and it's difficult. It's a subjective area. There's no easy answers to this. And I see the rise of passive in this space, and it really worries me because it is so open to hype and tick box culture. And it's expensive, right? To do that analysis is expensive. You've got to hire people. You've got to travel, maybe virtually at the moment. But there's nothing like actually going to the offices and seeing the culture of the organization and meeting the people in person. And hopefully we'll get back to that next year.
Iona, what about that point of kind of brand authenticity? You sort of touched on that as a very important issue for younger investors. But it can kind of almost kind of turn on a pinhead, can't it? That, you know, your reputation can die on, you know, one bit of kind of, you know, dodgy information going out there. I mean, how important is that brand authenticity to the younger investor?
It's important up to a point, though. In the book, I talk about the tendency to virtue signal, even though I know that's a phrase that not everybody likes, but I do think it has a place in the debate around ESG and social responsibility, because as David just pointed out, I think absolutely spot on to say that the growth of passive investing in this space is a cause for concern, and we're seeing lots of investors really outsourcing their thinking on these very difficult issues to passive providers. And that's why we've seen so many ETFs in the past year or so being established that are supposedly ESG, but are in fact indistinguishable from the big normal ETFs investing in the market. You know, the top 10 holdings for a lot of the ESG ETFs in the US they are indistinguishable from the regular ETFs. And that's because they have become over-reliant on investing in tech companies that can have some very questionable policies around tax, around workers' rights, automation, and even in the green space, they tend to be quite slippery in their definitions of what environmental progress looks like within their company. So I do think that younger investors can't just talk about this in vague terms on social media. We can't just keep saying we need companies to act in a greener way. We need to take ESG more seriously. Younger people need to be informed about what ESG actually looks like. And then we need to have some difficult conversations. Does that mean that we perhaps prioritize companies that are concerned more with the environment than they are with their own workers' rights? Does it have to be a trade-off between the two? In an ideal world, it shouldn't be. But as we're seeing, unfortunately, if we just have these kind of very lazy ESG screening policies, as we've seen in the passive space, then unfortunately that is a big risk. And I just think that as investors, younger investors in particular, get more informed and maybe get more clear-eyed about these issues, hopefully then we will start to see a bit of a better understanding about what it takes to actually achieve a more authentic ESG investing strategy.
Okay, just briefly, Iona, while you're on, there's a question about GameStop, which you touched on briefly during your presentation. The question is, will GameStop and the growth of free trading platforms bring greater volatility to stocks, which you sort of touched on? So that question, but also what have we learned from GameStop, do you think?
I do think that the controversy around GameStop showed that today it is possible for a share to rise and fall in a spectacularly short space of time, that we are seeing lots of people moving into the market, hoping to make money in a short space of time. That could happen again. Having said that, I think we have learned a lot from that episode. There was so much media coverage of the downsides of getting into those shares and hoping to make a quick buck. That I think that message will have got through to a lot of young people out there in this country. I think that also we are developing an understanding that actually, as I said at the time, these people who post on the Wall Street Bets community on Reddit, they're not the messiahs of Main Street. They're just naughty boys, and there's nothing wrong with that. They're having fun. I don't think we should demonize people who are engaging in that kind of behavior, but at the same time I don't think that we should be promoting it and endorsing it and encouraging it. And I think that the reaction that episode had in the UK was mostly negative, and I think that will get through to younger people and make them realize the next time that some crazy event happens in the stock market, screen it out and ignore it. And hopefully if we're getting sensible advice from the asset managers as well as the platforms, and David was quite right to say that all parts of the investment industry have to really step up and talk about the need to be diversified and to be sensible and to take a step back when crazy events happen. If we all step up to the plate and keep talking about that, I do think the message will get through to younger investors here in the UK.
Okay, Zed, there's a question in the box saying businesses will increasingly be managed to maximize stakeholder rather than shareholder value. Well, first of all, do you agree with the premise of that? And if so, how are you taking account of that?
It's a great question, because actually we are in a world where if you maximize stakeholder value, you also contribute to maximizing shareholder value. Because the world has changed, the approach of consumers, of end users, of your customers generally have evolved to focusing on, are you acting in the right way? Are you making the right impact on the environment, on societies? Are you paying the right amount of tax? And that's where the conflict is. Previously, maximizing shareholder value was about minimizing tax payments. Now, every consumer and end user expects corporates to pay the right amount of tax as an impact for better societies, for better environments. So if as a corporate you haven't understood that stakeholder value maximization does lead to shareholder value maximization, you haven't realized that things have shifted, and the focus has become on sustainability being the long-term creation of value. And then to pick up on what Iona was mentioning about brand, it's the same principle of brand. If you have a brand, you own the supply chain. Because if a supplier is rogue, if a supplier exploits in terms of age or gender or ethnicity, your brand will suffer. So you own the suppliers, and therefore you own the responsibility to improve the supplier standards and go and monitor them and assess them and impose on them the same values as you expect, and the same values as consumers and stakeholders and shareholders expect of you.
Okay, thank you, Zed. We've come very quickly to time. I'm just going to go around the panel. I'm going to come to you first, David, then Iona, then back to Zed, just for one final thought. After the kind of maelstrom of the last 12 months, what one simple message would you give people to take away when they're looking at their investment portfolio? David, first of all.
It's the same as ever, really. It's about being patient. None of us know when this pandemic will truly end. None of us know what the next 12 months or 24 months will bring to economies and to investment markets. And I work in it every day, and I don't know. So the point is to remain patient, to make sure your portfolio is focused on quality, not much leverage. You definitely want to hold some cash right now in arrears, because I think we will see greater volatility through the summer and into the second half of the year, both in fixed income and equity markets, and probably property markets as well, as investors and markets try to work out what the sort of medium-term impact of COVID has been. That will bring uncertainty, but it will bring opportunities. And it's these opportunities that we have to take, because these are the opportunities that really drive your performance, sometimes for 4 or 5 years. So I think keep it simple, keep it in quality, and keep something in arrears would be my kind of 3 top tips, if you like, from here.
Okay, Iona?
Well, anyone watching who is already an experienced investor probably knows what I'm about to say, but it really just builds on what David said, the need to diversify, to think for the long term. Maybe you don't have to have all your goals perfectly planned out, but to at least understand broadly how much risk you're willing to take. And then once you have settled on that strategy and you feel comfortable with it, to almost forget about your investments for a while. And I realized I'd made a big breakthrough recently when I hadn't checked my portfolio for quite some time. And instead of panicking and thinking that I was missing out on something, I realized that this was a sign of progress.
Okay, Zed, final word from you.
And that's great to hear that, Iona. Couple of things. One, sustainability is key to long-term viability of any businesses. And the same apply to investors. And so the importance of looking at investment as a long-term opportunity, and the importance of coming in early into investing, which is effectively what Iona's book is inviting its readers to do, is paramount, because we do face a pension shortfall. We do have longevity as a great outcome in terms of health and wellness for humanity. But with that comes the challenge of providing for your pensions, and therefore investing early and investing as long-term investors is paramount to ensuring there isn't going to be a pension crisis.
Okay, thank you very much, Zed, and to David and Iona, and to all of you for listening in. We've recorded the event, and a copy of it will be sent to all delegates along with the presentations. I hope you've enjoyed today and found it useful. There will also be a report on the event in the Scotsman on Thursday, which just happens to be April Fool's Day, which is completely irrelevant to the content that you will read. And finally, the moment you've all been waiting for, the competition winners. The signed copy of Own It by Iona Bain goes to Sarah Monaco. The Rathbones hamper goes to Alistair Stewart. And the Martin Currie Champagne winner is Mandy McFarlane. And Lauren White, who has organised this event expertly, will be in touch with all the prize winners. Thanks to you all, to the speakers and to everyone involved in the organisation. I hope you all keep well and continue to navigate your way through investment and through life safely and successfully. Enjoy the rest of your day, and we'll see you again, possibly in person, in 2022.